Speaking of yields, the 10-year has been dropping quickly, falling below 4.4% earlier today, compared with over 5% just a month ago. As for where rates go next, Bridgewater's Ray Dalio addressed the tug of war between Treasury supply and demand on Squawk Box earlier today.
I think the rate structure is going to be staying at its level, perhaps slightly less, but there's a range of uncertainty around that having to do with the supply-demand question. We're now at a period of time where the supply of bonds to be sold will be start hitting the market.
Well, my next guest says the November rally in stocks has simply been the flip side of those falling rates. So can stocks keep moving higher from here? Joining me now is David Bahnsen, CIO of the Bahnsen Group. David, it's good to see you again. What's your overall sense of things, both responding to that bull-bear debate we just had and this tug of war between stocks and rates?
Well, I was listening carefully to that bull-bear debate, particularly on inflation, Kelly. I simply believe that the inflation rate has a two-handle now, and I do not understand why more people are not talking about the difference between the CPI read on shelter versus every market read on shelter that we have. About 10 different surveys that show rent growth is really around 0%, and CPI saying it's 7%. But that's 34% of CPI. So we can all do the math. It's adding about 1.8% to the headline inflation number, which means you're around below a two-handle headline and about 2.5 on the core rate. Now, look, maybe the rent growth is 3%, not 0. The numbers are still right around Fed target and certainly going to be there in Q1 of next year.
So I'm going to put it a couple of different ways. You're dovish? Maybe you're bearish? How does this all shake out for you in terms of investments?
Yeah, so it's a great question because I don't believe the inflation debate lends itself to an easy either bullish or bearish. I mean, as far as dovishness with Fed policy, I hate dovishness because I don't like over accommodation. Zero interest rate policy is something I hope we never see again. It's highly distortive and it inevitably leads to a boom that follows with a bust. What I do believe is that we have weak economic growth, and we've had it for 15 years, and that I don't think there's any real significant pro-growth boom coming on, which requires investors to be more diligent, not begging for PE ratios to go higher, begging for some 50 times earnings company to go to 80 times earnings, but rather good organic cash flow growth. And that's why I think boring dividend growth investors like us are doing so well in this environment. It's a very good period for fundamentals.
A lot of the stocks you like have yields of 4 to 5%. We're talking about Leondell Basel, apologies for the pronunciation there, Kenvue even. IBM is in here. And Blue Owl Capital, quick one on Blue Owl. You think this is a private credit play? Are you bullish on private credit? Because it seems like there could be a lot of pent-up problems there.
Yeah, we're very bullish on private credit as a secular story, meaning the amount of fees that can be generated by having risk takers lend as opposed to regional banks. This is a secular trend that started post-crisis. It's not going anywhere. There will be more defaults in the future than there's been in a very low default environment. But even with some modest range of defaults, as asset managers, Blue Owl, Blackstone and Apollo are in that space too, and those are names we also own. But Blue Owl is very dedicated in this space around private credit, raising good money around real estate lending. And to me, it shows a secular trend, Kelly, that the banks aren't doing it, and now asset managers are. And I love that idea. Don't use depositor capital, use risk taker capital. It's a good model, even if every now and then there's, lo and behold, losses.